So if you buy a property over £125,000 in value in England or Northern Ireland, then we pay stamp duty land tax. If you buy any land worth greater than £150,000, we pay stamp duty land tax. Okay, so once you've completed the process with your solicitor, it'll all be factored into the completion statement. And those calculations are really important when we're thinking about the return on our investment. So what is the true cost of that capital investment as opposed to just the price that you're offering to pay? So a number of years ago now, the 3% surcharge was introduced on the normal banding for anybody purchasing greater than one property in England. Or if we're holding our properties in a limited company, we pay the 3% surcharge on the stamp duty banding for the first 9 properties that the limited company owns. Now, the Chancellor did say in the budget last week that the stamp duty land tax holiday will be extended from the 31st of March 2021 through to the end of June. So if you are thinking of potential investments and looking at those return on investment calculations, then that's very good news for anything that you're looking to complete. So the stamp duty holiday, just to be clear, is applied to the first £500,000 in property value. So we'll pay just 3% stamp duty. If it's your main residence, then we don't pay stamp duty at all. But we do have this 3% surcharge all of the time. He's going to taper that holiday back as well. So instead of the £125,000 stamp duty nil rate band, he is going to keep that, and he's going to make that £250,000 until the end of September this year. And then from the beginning of October, it will revert to the normal banding starting at 125k. As I say, you do, as property investors, have to pay the 3% surcharge, however. Another point to note is that property that is based in Scotland and in Wales have different types of stamp duty. Up in Scotland, any property that you'd be looking to buy, maybe as a holiday let, then you would pay land and buildings transaction tax, and that has its own banding. And again, in Wales, they have a land transaction tax, and again, that has its own bandings. So it's just a point to note that the stamp duty rates in England do apply to England and Northern Ireland, but there are different rules for property in Scotland or Wales if you're looking further afield to perhaps where we all live here. So just to put that into context in terms of how much it will cost us in stamp duty to buy a property in England. So going back to the rates from the 1st of October onwards, if we were to buy a £160,000 buy-to-let house in England, when we're thinking of that return on investment calculations, we also need to factor in that the stamp duty with that surcharge will be an additional £5,500. So it's not insignificant figures, especially with the surcharge introduced for the private landlord. Okay, so once we've got that property and we're holding it in our own name, then we have to think about the income tax. So again, modelling through any future investments, looking at the investments that we've got at the moment and looking at the return we're getting on those properties. And then let's have a think about income tax. So this is where you hold a property in your own individual name or individual names. So what happened in the budget, if you haven't been to a presentation with us about that or seen our communications on it, is that from the 6th of April 2021, the personal allowance will increase just by £70, so to £12,570 in total. Thereafter, will pay an income tax rate at 20. And that will be all the way through to just £50,270. Total earnings above that amount of money will be taxed at 40%. And if you earn over £150,000 personally, the additional rate of tax is 45%. What was interesting and important to note from the budget in your tax planning is that those rates have now been fixed for the next 5 years. So we've ordinarily seen an increase each year in those allowances based on inflation, based on tax policy. So what we're actually seeing is that those rates of personal allowance, and before we become a higher rate taxpayer, have been fixed for 5 years, which is great from a planning point of view, not so great from a taxation payment point of view. So just thinking of that in terms of an example, again, if you're in a job with a gross salary of £30,000, that's your employment income, and your profits for tax purposes from your rental property are £10,000, then you'll be falling in that basic rate of tax band and paying a 20% income tax charge on those profits, so £2,000. So again, when we're modelling, when we're thinking of our return on investment, when we're thinking about how much we're actually getting from earning these properties, we now know for the next 5 years what those taxes are going to look like. Completing the circle and thinking about investments that you have, or thinking about investments that you want to make, maybe to flip them in the future, then when we dispose of a property, we pay capital gains tax. So you may have bought it, renovated it as an example, let it out for a period of time, or not even let it, just simply flipped it and made a profit. If we make a profit on that transaction just there, then we pay capital gains tax. So again, thinking about it from a property owned in our own personal name, then any profit that we make as an individual on capital gains in any tax year, we have a nil rate band. So the first £12,300 of capital gain is free of personal tax. Thereafter, we have to pay taxation. Again, the £12,300 is a figure that we might be familiar with because that was the nil rate band for this year. Again, there has been no movement in that nil rate band announced in the budget last week. So that rate stays in place. So just thinking about capital gains tax, when we're thinking about that calculation, we're taking the sales proceeds that we generate from the property. We're subtracting from that any disposal costs, so estate agents' fees, solicitors' fees. If we've purchased the property to flip and we've undertaken some large renovation costs, then that is also deducted in the calculation for capital gains. We obviously have the original cost of purchasing the property and any costs that we incurred in purchasing that property, so stamp duty, solicitors' fees. So the level of capital gains tax we pay is either 18% or 28%. This is one of the things that we thought in the budget would change and thankfully hasn't. So if you're a basic rate taxpayer for income tax purposes based on the bands that we've just talked about, if you dispose of a property, then your capital gains tax rate is going to be 18%. If you're a higher rate taxpayer for income tax purposes, when you dispose of a property on that capital gain after your annual exemption, your nil rate band, you'll pay 28% capital gains tax. To strongly push something here, then we saw the change from April 2020 that when we dispose of a property, we have to pay our capital gains tax within 30 days of completion of the sale. So previously, we simply put our capital gains tax calculations on our annual self-assessment tax return. And that doesn't happen any longer. We have to fill in a separate document with HMRC and pay any tax that is due within 30 days. We also used to talk at the days of having the seminar about letting relief. So this was a reduction in capital gains tax for landlords who'd lived in the property before they previously let it out. Again, there was a change from April 2020. So just to remind you or to reiterate, that lettings relief is now only available for live-in landlords. So where you're living with somebody and have shared accommodation. So you occupy a property with your tenants. The private residence relief still does exist, however. So this is a percentage reduction in the capital gains tax based on the number of years that you lived in a property, plus a further 9 months before you sold it. So again, that used to be an 18-month rule, and that was reduced to a 9-month rule back in April 2020. So just as an example again, let's say you lived in a property for 5 years and then you let it out for 15. You'd get principal private residence relief for those 5 years that it was your home, plus the last 9 years that you rented the property out, 9 months, sorry, you rented the property out. So for 5 years and 9 months, that in total is 28.7% of the time you owned the property. And therefore you'd get principal private residence relief on 28% of the gain that you made. So HMRC never look at market rates of when you exited the property as your principal private residence. In that example there, we've assumed a linear growth over the 20 years that you've owned that property. So it's always quite a bugbear when it comes to capital gains. Just moving on to the next slide, what we have talked about is income tax and capital gains tax when we own the property personally. So we've all seen the shift, and for those that are a little bit more experienced, we know that many people, and maybe some of ourselves, have started to look at owning property in a limited company as opposed to owning it in our own personal names. Some of the reasons we'll go into a little bit more detail about in some examples further on. But just completing the rates of taxation section, limited companies are their own separate legal entity, and corporation tax is 19%. And the limited company, when it owns property, pays corporation tax at that rate on either capital gains or on its profits from its trading activities. And what was announced in the budget last week was that rate of corporation tax is going to be fixed for the next 7 years, where the profits of the limited company are less than £50,000 per year. So unless we've got a significant portfolio, then that rate is now again known to us. If you're looking at a portfolio with profits of greater than £50,000 worth of profits, then the corporation tax rate will be on a marginal rate somewhere between 19 and 25%. So it was quite a shock to entrepreneurs to be seeing in the press that significant corporation tax rate, which of course will affect property landlords with significant portfolios held in the name of the limited company. So we're going to move on to our next section and start thinking a little bit about the tax effective ownership of property. So just stepping back a little bit about who pays property tax. So whoever benefits from owning the property pays the tax. Finding that person means following the money and dividing it between the owners or those who are paid from it, such as maybe having a property manager. So it's very It's very key here to realise that there's quite often tax mismatches, and HMRC are always all over the property landlords when it comes to things like that. So it's quite often the case that one partner in a relationship may declare all of the property when actually, in fact, the property is held in joint names. But one partner is putting all of the income and expenses onto their tax return, so the basic rate of tax, as an example, is paid. There are ways that we're going to talk about legally of transferring allowances within a marriage or civil partnership, or looking to form a business partnership. But we shouldn't be misrepresenting the tax situation by simply hiding who gets the money, saying, oh, my wife gets the money from the rental properties, when it's in joint ownership, simply doesn't wash with HMRC. When we're thinking about tax planning for our rental properties, we have to consider the landlord that has several different properties, and maybe those several different properties appear on different sections of a personal tax return. So we always pull together properties. We never have to report to HMRC the tax payable on each individual property. As an example, we look at a portfolio as a group. However, we do have to think when we're tax planning about the fact that we can only pull together properties held in the three different categories as follows. So firstly, our UK rentals. So where we've got a short hold tenancy, or we have shared houses that are rented out, they go onto one area of our tax return. If we have overseas rentals that are let out on a long lease, so you own a property abroad and you have a family in Florida live in that property as their main home for, say, a 1 year period, that property is considered to be in a different pool. And then the third area is our holiday lets. So if we're renting out properties that qualify as furnished holiday lets, we have to be keeping the records and those properties separate from any of those in our other two categories. So furnished holiday lets have become increasingly popular within our client base over recent years, which we'll go on to see the reasons why. But we have to remember that we have to keep the accounting for those and our tax planning for those particular properties different to, say, a house in Highbury Vale on a 6-month short hold tenancy agreement. Just considering the section of the tax return about what happens if a landlord makes a loss. Well, this can be a tax planning point, but we have to be careful. If we have a loss on our rental property portfolio, so maybe we just have one property, it's on our tax return, and we've had a difficult tenant, we've lost lots of income, and then subsequently done a number of repairs on that property to re-let it. Sometimes we're in a position we do make a loss. So that basically means our allowable expenses are greater than our rental income. It's not something that we want, and we certainly don't want it to happen often. We cannot store up the losses to use it as it suits us. We have to carry forward the losses. We can't offset those losses against other sources of income. So if we're self-employed alongside running our rental portfolio, we can't decrease our profits in our self-employment, as an example. If we're employed, we can't offset it against our employment income and any taxes that we've paid there. So if we carry forward those losses, we have to use them in as soon as we can. So if we made a loss in, say, 2018-19, and we paid no tax in the year, we had a loss of £3,000 and we carry that forward against future profits. And the following year, so 1920, my expenses are under control and I make a £2,000 profit. Again, I pay no tax. I've brought forward £3,000 I've utilised £2,000 of it, and it gives me a further £1,000 to carry forward. And I take that into 2020, 2021 tax year and utilise that against any profits. And I can keep carrying those losses forward. As I say, I hope with planning and modelling, we never find ourselves in a position of continued losses. But just to be clear, that once those losses are made, they carry forward to future profits. We can't sit there and utilise them against other sources of income, or hold off because we're going to be a higher rate taxpayer in 2 years' time. So we want to save tax at 40% rather than 20% maybe today. So when we're thinking about income tax or the calculation of corporation tax on an ongoing basis, then we have to think about the calculation of profit. So if we move forward on our slides, what we're going to talk about next is what expenses we can claim and what we can't. So we pay tax either in a limited company or personally on profit. Profit, rental income, less deductible expenses. Well, rental income is a given. There's nothing that we can do to change that. If we've generated the income from our portfolio, that is what goes onto our tax return. What we can, however, do is we can ensure that we're claiming all of the expenses in our rental property portfolio, that it's possible to do so. And therefore, it's really key that you have a good understanding of what expenses you can claim for in the calculations of profit, and therefore reduce either income tax, corporation tax, depending on how you hold the portfolio. Again, when we're looking at modelling any properties that we're looking to invest in, it's really important that we're listing out all of the expenses that we could be claiming. So we're getting a realistic picture of what our return on that investment is going to be. Or if we're looking to release some of the properties from our portfolio, we can start to break down any particular property and look at the return on that particular investment based on what we've paid for it and how much income profit we're generating on that particular property. But we have to be clear on what expenses we can claim. So to be clear, when we have a really specific receipt, you're already good at handing those over and logging them. So a specific receipt, maybe something like a service charge because you have a leasehold flat, ground rent, or a repair bill from the decorator because he's done some painting for you. There are costs that are perhaps more dual costs that we need to always make sure that you're presenting either yourselves on your tax return or handing that information to us. So the first thing to think about is that the default position with HMRC now is that we account for income when it is received. So we do cash accounting. In the olden days, we used to have to declare what rent we should have received and write off anything as a bad debt that had been taken into courts and was irrecoverable. But now the default position on your tax return is actually to cash account. So to actually take the income onto your tax return that you've received from your tenants in the particular fiscal year. So from the 6th of April to the 5th of April, or for corporation tax purposes within your own accounting reference date year. So just think about it. If you've had a bad tenant or if COVID has caused some issues within your property rental portfolio. Things sort of in terms of those dual costs to think about is making a mileage log and making mileage claims against your rental property income. So you can claim mileage at 45 pence per mile, just like anybody who's self-employed or employed uses the fixed car profit scheme. So that's traveling from your home to the property to maybe do inspections, maybe to meet suppliers for quotations, to come to see us, to attend an auction because there's a property you particularly like, to visit the management agent. So you should keep that mileage log as part of your accounting records. You can pay friends and family and employees who do not own a share of the property if they're doing work relating to running the property. So this is where we can start to use maybe children, partners, or friends who do assist you with the running of your property. But the rate of pay has got to be at arm's length. So as an example, you can't pay your husband £50,000 to keep the books for your buy-to-let property. That would just be seen as tax avoidance. If your husband is self-employed and he raises an invoice to you for £500 for helping you with the maintenance of your accounting records, and then that's fine. He's going to pay the tax on it. You get the tax relief on that. He may be a 20% taxpayer. You may be a 40% taxpayer. So you can start to see the differential there. Or if you've got a child potentially where you've maybe paying for their student accommodation and they help you with renovations in the holidays, and maybe you've got a big student portfolio and you have to do big refurbishments each summer on those properties, and you have one of your children that helps you do that, we can look to set up a payroll scheme and pay them as an employee. That's a deductible expense. It will decrease the profits on which you pay tax, maybe stopping you being a 40% taxpayer, and give them money legitimately within their tax band, potentially, or at a tax rate of 20% if they have another source of income. And you might have otherwise given them that money. So there are options and opportunities available, but they can't be somebody who owns that property with you. They have to be independent of that property. You can also pay for training as long as it's reinforcing your existing skills. So sometimes we meet people who've signed up to one of these get rich as a property investor schemes. That isn't a tax deductible expense. But buying a book on property tax for landlords, attending a Landlords Association seminar and paying a fee to attend that, they are deductible expenses and should be listed and logged so that they help the business, your property business, reduce its profits and save you income tax or corporation tax. If you manage the property yourself, then maybe you should be looking to put a percentage of your telephone and internet bill through the property. Becomes a little bit more meaningless if you do have management agents involved, because really they're probably just going to drop you an email each month. And if you're running a portfolio and it's your primary source of income, we can be claiming the Use of Home Allowance, which is currently set at £6 per week. So that's been since the 1st of April 2020, that new rate. So again, small amounts, but things that start to decrease those profits and save you tax. Remember the bigger things as well. Fees for professionals. If you're using accountants, if you're using those management agents, your surveyors, a solicitor to help you with a problem tenant, they are all tax deductible expenses. When you actually acquire the property, those solicitors' fees are not deductible. That forms part of your capital gains tax computation further down the line. Most people own property with a mortgage. So interest, just to reiterate what's happened to the private landlord over the last 5 years, is that landlords used to be able to claim tax relief on interest payments on borrowing funds that are associated with the portfolio. That tax relief has now been phased out for individuals. But it hasn't been phased out for individuals where the property is a furnished holiday let, which also, as defined at present, would mean that Airbnbs. So we saw a significant shift of one of our clients 5 years ago following a seminar over at Bramcote Golf Club when we could all have a beer afterwards. And they owned a lot of property in Cromer. They'd run their property portfolio at a loss for a number of years. And over the last, well, certainly 3 years following that seminar, they converted all of those properties into furnished holiday lets. We've had to VAT register them because their turnover is greater than £85,000. And last year, their profits were in excess of £60,000. If they'd have kept those properties as buy-to-let in their personal names, they would have had to have sold. They could not afford to pay the tax and the interest. So when I talk about modelling all of the time and keep reiterating to you about the return on investment, the biggest factor that should really be taken into account when we're thinking of our rental properties is how we're financing it. And if we're financing it through mortgages, can we afford the tax? Will we get a return? Because all we're going to receive is a 20% tax credit. That, to the basic rate taxpayer, is fine. There was actually no financial impact. We just account for it a little bit differently. But most property owners are higher rate taxpayers. They're entrepreneurial, they have a good job, and they're running the property as a secondary source of income. And all of a sudden, as you'll see in some examples when we talk through them later, is that you will find landlords now that are higher rate taxpayers paying more tax than the profits that they earn on the property. So furnished holiday lets still work in our private name if we're a higher rate taxpayer, because interest is a deductible expense. Interest is not a deductible expense to anybody. We get relief on it at 20%, and it means the higher rate taxpayer has significantly been hurt over the last 4 years. That phasing out that took place since 2016, ended last year. Okay. Remember that you can only ever, and we could only ever, claim the interest element. So if you are running loans that are repayable, mortgages that are repayment, then when we're modelling, we need to think about the cash flow impacts of making the loan repayment. But when we're calculating profits for tax purposes, we're only taking into account interest. So we're going to start looking in a little bit more detail at some examples later on with regards to interest. Repairs and replacements are the other area that sometimes people get a little bit confused with in terms of expenses. So a replacement is a deductible expense. It means replacing or renewing part of the fabrication of the property. So you're repairing the pump on your boiler, you are putting new tiles on an area of your roof, or you're doing a like-for-like kitchen refit. Those are all repairs. They're deductible expenses in our property portfolio. An improvement is where we're making some kind of substantial upgrade that adds value. So maybe we're adding an extension, we're putting on a conservatory, we're doing a loft conversion maybe in a student property. Those fall part of our capital gains tax computation. We can't deduct them as ongoing expenses in the calculation of profits for income tax. We can also claim for the replacement of domestic items. So if you're running student accommodation or that furnished holiday let, and we're having to replace movable furniture, so example, a bed, furnishings such as curtains, a TV, a fridge, so household appliances, or your crockery, so kitchenware. And the replacement of those are deductible purposes. The initial purchase of those items isn't. So you can see the differential there as well. I'm not married, as many of you know, but the next section that we're going to talk about is how we can perhaps play with our tax a little bit more for those of us that are either married or in a civil partnership. Okay. So there's a few scenarios that I want to talk through when it comes to being married and how we can use that potentially to save us some tax. But if it's something that you're thinking about, then you need to talk to us, because there's some legal implications as well, okay? The easy one is about the marriage allowance. So if one of us doesn't pay income tax and the other does, not only for property income purposes, but for any kind of personal tax purposes, then are you claiming the marriage allowance? Should you be claiming the marriage allowance? So the marriage allowance is in place for where one part of the couple is earning less than the personal allowance. So as we saw earlier, £12,570 a year from April. If the other partner in the relationship is a basic rate taxpayer, so earning less than £50,270, we can basically claim an allowance, which is 10% of the personal allowance. So if you claim the marriage allowance, because that scenario works for you, I can save you £251.40 in tax. The partner with the lowest income needs to claim the marriage allowance online, and the person with the higher income makes the additional personal allowance claim through their self-assessment tax return. Okay, teeny saving, but well worth doing if that hasn't been picked up on before. What happens when both of you pay income tax? Well, should we be setting up a partnership? Should we be taking our property portfolio and saying that we own the properties jointly? So business partners share the responsibility for any losses, they share the responsibility for the bills, and they share the responsibility for the taxation on the profits. So each partner in a partnership pays tax on their earnings from the partnership. So if somebody, say Ben, he has her property portfolio, he marries Andrea, Andrea earns £15,000 a year as an employee and Ben earns 50k. Well, Ben previously, or without a partnership, would be, say, paying tax at 40% on a £30,000 profit on his rental property portfolio. So that's £12,000 a year in tax. If we were to set up a partnership, the automatic assumption is that the income is split 50-50 between each partner. So Andrea would pay tax on her half at 20%. Ben would still pay tax on his half at 40%, but the income tax payable would come down on that little example there to £9,000 a year. Maybe we could start to look at a partnership split that isn't 50-50. We have to be careful, we have to think about it, but maybe we could get to a 75-25 split or an 80-20 split. A partnership has to complete its own tax return, as well as each partner having to complete their self-assessment tax return as well. So we go from potentially one tax return in that scenario to 3. But that is a nice cheap option potentially to do some tax planning without significant mortgage company fees or without significant solicitors' fees. And if you're setting out with a property portfolio with a friend or a mum, sibling, whatever it happens to be, then setting up that partnership and looking at that tax planning in the early days, actually before acquisition, is really key. So moving on to look at what happens if you pay the higher rate of income tax. Now, the limited company model is something that potentially works. We'll see some examples where it doesn't in a few minutes, as with anything. But the limited company is that separate legal entity. It pays its corporation tax, as we've talked about. We know what those rates are going to be. The advantage of the limited company being that separate legal entity is we can really tax plan, and we can tax plan hard. We can do all sorts of things. We can start bringing children into the fold potentially as shareholders of the limited company and distributing dividends to them. We can pay salary to all sorts of different people in the family, depending on how your portfolio is set up. But the absolute key difference is that that mortgage interest is a tax deductible expense. So if you're a higher rate taxpayer, you're getting only 20% tax relief. You're potentially paying more tax than you're earning in profit. To move that portfolio or to have purchased that property in the first instance as a limited company and be paying only 19% corporation tax on its profits, which will be lower because that interest is a deductible expense, is fantastic. The problem we all have is that moving our existing portfolio into a limited company is nearly impossible. We said it's a separate legal entity. What we're effectively doing is we are selling our own property into the name of a limited company. And in doing so, it's a legal sale. We're incurring stamp duty because it's a trigger, it's a sale. And if we've made a good capital gain, since we've been owning it in our own name, we have to sell it at market rates, and therefore it triggers the capital gains tax as well, which potentially means if we're a higher rate taxpayer, which is why we're doing it, we're then handing over 28% of those gains straight to the taxman within 30 days of completion. So we've all struggled to make that move. What we don't struggle with, however, is understanding and looking at scenarios when we're looking to invest. How long are we going to own the property for? Are we doing it to flip? Are we doing it as a long-term investment? How much money do we think that that property is going to make us? How are we going to finance it? We can model all of those things through. We're not always right because the scenario might turn out differently. But if we've made the decision based on damn good reasons, then you can never be angry with the outcome. Okay. So what we're going to do is just look at a couple of examples with numbers, please. Okay. So this is just some simple modeling just to really emphasize the mortgage interest point. In the first column here, we have an individual. He's a higher rate taxpayer. His rental income is £25,000 a year. His expenses, so his repairs, all those bits and pieces are 10K. His mortgage interest is 15K. It's a highly geared portfolio. He's just banged in deposits and he's paying interest. Hasn't got a great credit history potentially either. Profit, for accounting purposes, said I made no money. But remember, he only gets tax relief at 20% on that mortgage interest. And therefore, he is paying now, in real terms, £3,000 a year personal tax, and he doesn't earn anything. Thanks, government. I've never, ever been in this scenario that I had to explain this 5 years ago to clients. I remember the seminar badly. If he owned that property in a limited company, moving on to the next column, the profit is zero and he pays zero corporation tax because interest is a 100% deductible expense. Bonkers. Looking again at a different scenario, I'm an individual, I'm a basic rate taxpayer, I've got my £25,000 worth of income, I've incurred £1,000 worth of expenses, I've got a damn good property, my mortgage interest is low at 3K, I'm showing profits of 21K, my tax is £4,200, I run it through a limited company, my corporation tax is 4K. Well, I'd probably keep that in my own name if I ran that scenario rather than putting it into the limited company. And the reason I say that is the expenses of running the limited company are going to outweigh that little difference there in terms of the taxation rate. Okay, the danger is I might become a higher rate taxpayer. Okay. So you might be sitting here thinking, every property I buy going forward should be in the name of a limited company. The reason why we need to understand the long-term investment in that property, if we move to the next slide and consider capital gains tax, is that if I come to sell the property, so my aim is to flip, my aim is I don't really know what I want to do, I'm just going to give this one a go and see how it works out. I'd probably better keeping it in my personal name. And we can see why here. I've made a capital gain of £14,000. Holding it in my individual name as a basic rate taxpayer, I pay tax at 18%, and I have that personal allowance of £12,300. I'm only going to pay capital gains tax of £306. Even as a higher rate taxpayer, I'm going to pay £680. If I bought that property in the name of my limited company, there's no nil rate band because it's a separate legal entity. Every pound in income profits, trading profits, or every pound in capital gains that the company pays, it pays corporation tax at 19%. So that property that I'm buying and I flip, I want to hold that in my own personal name, do I not? Because my corporation tax is going to be £2,660. That's a big difference. That's probably the difference between me deciding to go ahead with that property or not. Okay. So this is why when people say to me, should I buy the property in my own name, Linda, or should I buy it in the name of a limited company? We ask so many questions, and the questions that we start to understand with our clients, and clients start to understand, and we can start to model and invest and look at our returns and look at the future. What tax am I going to pay now? What tax am I going to pay in the future? What works for me? Okay, quite a passionate subject of mine, but we have to make our decisions based on those models, because then we know why we chose to do what we wanted to do. So just moving on to think about the budget that took place last week. We've covered all of these points as we've gone along, but just to emphasize that we found out a lot of information in the budget that will impact upon our property decisions. Corporation tax rates are set. We know that there's going to be this increased rate of corporation tax, but it's only where profits are greater than 50k. We know about the stamp duty land charge, nil rate band extension, and the phasing back in and when those dates are. The personal tax allowances and bands are frozen for 5 years, so we can plan. We know what our property portfolio or a particular investment is going to look like. And exactly the same with our capital gains tax as well. If we're looking to sell something, we know that things aren't going to change this time. We're all the time thinking, oh, but what happens if so-and-so happens next year? We know those rates and we know those bands. It's quite a powerful decision to be helping us see the future for a change. Okay. There are further changes ahead for the property landlord. So there are two things that I just want to talk about with regards to the future. I cannot emphasize enough how quickly the 30-day rule for the capital gains tax post-completion documentation goes by. It's 30 days, not 30 working days. You have to register with HMRC. You have to get a transaction code. We then have to get authority to help you fill in the form. And with all this going on, we have to find the numbers. So if you are in a position that you are selling a property, can I please ask that we're starting to collate the information whilst you're going through the sale process, rather than just coming to us post-completion. We have missed as many deadlines as we have met. That is not Calisco style, as those of you that work with us know, and it's not something that we want to keep repeating. So please, 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 if you're selling, keep us in the loop. We'll keep telling you what we need, and it'll help you. Making tax digital for landlords is the final thing that I want to talk about this evening. It's been on the cards for some time now, and the government have finally given us a date when they're going to start asking for quarterly returns from the landlord in certain circumstances. So the date that you all need to be aware of is the 6th of April, 2023, which is only 2 years away. From that date, if you have rental income of greater than £10,000 a year from property, then you will need to be using accounting software So just like any VAT registered businesses that we have here this evening that have had to go through the transition of making tax digital and doing their VAT returns with software, then you're going to need to use software which aligns with HMRC's online processes right from the 6th of April 2023. You're going to need to file quarterly returns using that software with HMRC. So plenty of you use spreadsheets. Some of you use a carrier bag of receipts. We love you. We have no problems with that. But the revenue are going to, and you have to make this transition. We do think that this date is going to be set. The software houses are all over it and are pushing software into the landlord sector. So Xero, as an example, XERO, have been pushing significantly into the landlord market space. They're tapping into it as early as they possibly can. So what's going to happen is you're going to record your information onto software. You'll send HMRC quarterly updates of your income and expenses via that software and using a HMRC digital tax account. It could be as simple as clicking a button, but what it's basically doing is allowing HMRC stroke you to calculate your tax as you go. And what will happen is at the end of the year, instead of sending in a completed self-assessment tax return, or getting us to do it, or in the case of a limited company, it's completing a corporation tax return, you'll sign a declaration that your quarterly returns are accurate. And then you'll pay your tax still annually, as usual, on the 31st of January. HMRC have said that it's still considering the penalties for taxpayers that don't understand this and don't get this. It might give you a few months leeway, but making tax digital has been on the cards by the government for so long now for the landlord marketplace. They don't like us, that's for sure, and they keep making our lives difficult. And it appears that we're going to be the first group of people making these quarterly returns if we meet that rental property criteria. So when I'm making communications about MTD for landlords, as we find out more over the coming months, make sure you're keeping abreast of that with us, please. So in conclusion this evening, the tax liability that you pay is based on the profits that your portfolio earn you. It's really important to me that you're making the most of your property assets and that we're taking all that we can from our properties and making sure that we minimize our taxes. But it has become increasingly hard, without a shadow of a doubt, to save taxation with our current government, certainly with the landlord marketplace as well. So the idea of these workshops and our communications to landlords is to always try to educate you, give you some tips and hints, and make you think, so you can come and see us at any point or discuss your own personal circumstances. But MTD for landlords does look like it's on the horizon. So making sure we're recording those expenses now, so we get into a good system for the future to minimize those taxes is absolutely key from this evening. Thank you for your time. Thank you very much for joining us this evening. It's always a pleasure to see you. We've always run this seminar each year, probably for the last 10 years.